So today we'll try to understand how to use existing models, the features of existing models, to build a model that will generate new interesting insights. We will start with a paper by Antoine Faure-Grimaud and Denis Gromb. This paper goes against the traditional view of monitoring incentives, which is that the larger the stake of a firm's monitor, so think about, for example, a venture capitalist, the larger the extent to which this monitor will internalize the effect of his actions. If you own a greater percentage of shares in a firm, you're going to have stronger incentives to make value improvements. Okay, this is consistent with the idea that a large monitor can play the role of a principal in an agency problem because he combines two things, right? He has the incentives to be informed because he owns a large percentage of the firm. And he also has the power to take action because by owning a large percentage of the firm, he will have enough control rights to take any value increasing actions, for example, terminating the manager, changing the payout policy, and so on. So this is consistent with many papers. For example, in Bertrand and Melenatan, when they look at pay for luck, they conclude that managers in firms without a large blockholder, so that they call without a principal, set their own pay. This is the perspective of many other papers as well. Okay, but in this paper, Antoine Faure-Grimaud and Denis Gromb take a different perspective. And they do so by combining a Kyle model for price determination, or at least a modified version of a Kyle model, with a moral hazard perspective in which the actions of an insiders can improve firm value. So what is this model? Everything will be as simple as possible, but not simpler. Firm value can be either equal to VH or to VL, and with VH greater than VL. High firm value will happen with this probability. So it is increasing in E, and so E is effort. And so you can see here is in between 0 and 1, so that this probability will always be in between 0 and 1. As well as the complementary probability. So E is the effort exerted by the insider. So think about the insider as a venture capitalist that's invested in the firm. And of course, effort is costly, right? You can make value improvement, but that will require that you spend time and resources monitoring the firm. That will be costly. And so there's a cost of effort for the insider. And the insider owns the fraction 1 minus alpha of the firm. So he does not own the whole firm. And as long as he doesn't own the whole firm, so as long as there is some free float alpha, there's going to be a trading gain. And so the value of the firm is going to be determined by stock market trading. So there's 3 players. So it's like in the Kyle model. So there's going to be some liquidity traders who submit a random demand DL, which is going to be either minus D or 0, meaning that either they're going to sell a quantity D, or they are going to not do anything. And so each with probability 1/2, minus D or 0. There's an informed speculator who can observe firm value at a cost. So if he pays this cost, he'll be able to observe firm value. And then he's going to submit a demand DS for speculator. DL is for liquidity trader. So it submits a demand DS for the firm stock that will be optimally determined. And then a market maker. So he's going to observe each of these orders. So he observes DL and DS. Of course, he doesn't know which trader submitted which order. Orders are still anonymous. And so this market maker observes the set of orders submitted to him, and then he set the firm stock price P in such a way that he makes 0 expected profits. So that's, again, exactly like in the Kyle model. So he's going to update his beliefs about firm value. And the stock price would be equal to the expected firm value given the market maker's information set, which is the orders that he observes. Okay, so pretty standard. Now, before the realization of firm value is observed, with some probability, lambda, the insider who can make value improvement, is going to be hit by a liquidity shock, in which case he will need to sell his shares. Okay. So why is that happening before we know what firm value is? Because then we know that trading by the insider will not be based on private information. And so it will not affect the market price. Okay, so to summarize, this is the firm value distribution. And crucially, it's going to depend on the effort of the insider. This is the demand for shares by liquidity traders. Now, with some probability, they're going to sell D. With some probability, they don't do anything. And this is going to be the demand from the informed speculator. Okay, so the informed speculator knows that if he submits anything other than minus D or 0, it would be identified by the market maker. In which case he will make 0 profits because he will fully reveal his type and therefore his information. So what can this informed speculator do? Well, if he observes, so if he is informed, first of all, if he is informed and he observes that firm value is low, then he's going to sell the same amount that liquidity traders would. And if he's informed and he observes that firm value is high, then what can he do? Well, the best thing he can do is not do anything. Okay, any other order will reveal his type and would result in 0 profits. So let's summarize what's going to happen. So there's 4 possible cases, right? So here, 2 different cases depending on the liquidity demand by liquidity traders, whether they sell with probability 1/2 or they don't do anything with probability 1/2. And there's going to be 2 cases depending on the information of an informed speculator. So depending on whether firm value is low with this probability or is high with this probability. And then depending on the relevant case, this is going to be the demand by the speculator. Okay, so based on that, so based on all these cases, there's going to be orders submitted to the market maker. And so this is going to be what the market maker observes in each of these cases. Okay, so here the speculator does not do anything, but the liquidity trader is going to sell D. And here it's the opposite. The liquidity trader does not do anything, but the speculator is going to sell D. And in this case, no one does anything. Okay. So first, let's take the perspective of the market maker. And let's ask ourselves, so how is he going to set the market price? Based on his information, so based on the orders that he observes. So in his first case, when everyone is selling, is going to infer that the informed speculator is selling, in which case he knows that firm value is VL. Okay, so that's easy. In this case, the stock price is simply going to be equal to VL. Another easy case is when no one does anything. What does that imply about the information of the speculator? It means that the speculator observed that firm value is equal to VH if he's informed, in which case the price will be equal to VH. Okay, so the more interesting cases are the cases when the market maker is going to observe this or that, which is indistinguishable from the market maker's perspective. And so in this case, so what is going to be the stock price? So this is a general formula for the stock price. It's equal to this. In this particular case, when the market maker observes these orders, the stock price will be equal to V hat, which is defined like that. So what is V hat? So let's take conditional expectations. So we're going to use this formula. So the expectation of V conditional on these orders is going to be equal to the probability that V is equal to VL conditional on these orders multiplied by firm value in this case, so VL, plus the probability that V is equal to VH conditional on these orders multiplied by the firm value in this case, VH. So we use the formula for conditional probability. So this is a probability of having these 2 events occur. So what is the probability that firm value is VL and the observed order are 0 and minus D? So firm value is VL. When do we have 0 and minus D? This is when DL is equal to 0. So that happens with probability 1 minus E over 2 multiplied by 1/2, because these two events are independent. Okay, so this term here is equal to that. Now we do likewise. What is the probability that these orders will be observed? Well, it occurs in two cases. In this case, with this probability multiplied by this probability. And in that case, with this probability multiplied by that probability. Okay, so this is the probability with which we're going to observe these orders. We do likewise with this second equation. So here, this is a probability that firm value V is VH and that we observe this set of market orders. When is that happening? That is only happening in this case, which occurs with this probability multiplied by that probability. So now we simplify this fraction, it's equal to this, likewise for this second fraction, and we find that V hat can simply be rewritten like this. So this is for the case when the speculator is informed. Okay, so now let's take the perspective of the speculator. So as long as he's informed, his expected profits pi will be equal to what? Well, first of all, so when is he going to make some profits? Well, he's never going to make any profits when he's not trading. So when ds is equal to 0, here profits will be 0. When ds is different from 0, so what's going to happen? In this first case here, the orders are fully revealing about the firm's type. So then the market price is equal to VL, which is equal to the firm's true value. So the speculator is not going to make any profits. That's 0 profits. So only in this case is he going to make some profits. In this case, which occurs with this probability multiplied by this probability, which is what you have here. In this case, his demand is equal to this, and he is going to sell at this price a firm which is really worth this much. Okay, so he's going to make profits of D, the quantity that he sold, multiply by this, which is positive because V hat is greater than VL. Okay. And so when the speculator becomes informed, his expected profits are increasing in D. So the larger the amount D that liquidity traders are selling, the larger the amount that the speculator can sell when he has some negative information, and so the better off is going to be. And so this is why a liquid market is actually quite important to motivate informed trading, because it's going to result in higher expected profits from informed trading. And so in the model, it is assumed that the cost of being informed, K, is actually distributed according to some distribution. And so its realization can be such that it is greater than pi or less than pi. If K happens to be less than pi, than the expected profits, then the speculator will optimally become informed, right? Because the expected benefits here are larger than the cost of getting the information. In the opposite case, in which the cost of information is greater than the expected profits that can be derived from this information, then the speculator will not become informed. Okay, so there's two cases. Let's start with the case when the speculator is informed. So what is the expected stock price conditional on the speculator being informed? Then we're back to this table, right? So there's 4 cases. With some probability, this times this, the stock price will be equal to VL. With some probability, this times that, the stock price will be equal to VH. And otherwise, the stock price will simply be equal to V hat. Okay, so this is what we have here. And if we use the expression for V hat that we got in the previous slide, we can rewrite it like this. This is a stock price conditional on the speculator being informed. And now let's take an ex-ante perspective that's going to be relevant from the insider's perspective. When the insider is going to decide on his effort, he is going to want to know what is going to be the expected stock price at which I would be able to potentially sell my shares. Now remember that this insider might be hit with some liquidity shock, with some probability lambda, in which case he would need to sell his shares. So he would sell at the stock price P. And so at the time of choosing his effort, he's going to take expectations to understand, so what would be the expected stock price at which I would be able to sell my shares. So again, there's two cases, depending on whether the speculator is informed or is actually not informed. And of course, the insider does not know that at the time of taking expectation and choosing his effort. So with this probability, the speculator is informed. That comes from this. And in this case, as we already determined, the stock price will be equal to that. Okay. Now with that probability, the speculator will be uninformed. And in which case, so what would be the expected stock price from the insider's perspective? Well, in this case, the expected stock price is going to depend on belief updating by the market maker. The market maker knows that firm value follows this distribution. And so this distribution depends on the anticipated effort E by the insider. And so here the market maker is going to postulate that the effort is going to be equal to EA. So this is the anticipated effort. Of course, in equilibrium, the anticipated effort must coincide with the actual effort. But the point is that if the speculator is uninformed, the actual effort E of the insider does not matter, right? Because there will not be any informed trading, so the speculator will not reveal any information. And so then the actual stock price will be independent from the actual effort E of the manager. The actual effort E of the manager is only going to matter when the speculator is informed and is going to engage in trading. So when the stock price is going to follow this distribution. That depends on the actual effort E chosen by the manager. And so now based on this, so what are the insider's effort incentives? So the insider is going to maximize his objective function by choosing the optimal level of effort E that maximizes this expression. Okay, so there's a cost of effort. And then what is going to be the manager's wealth? So it's going to depend on the insider's stake in the firm, which is 1 minus alpha. The insider owns this fraction of the firm. And then there's two cases. With some probability, the insider is not hit by a liquidity shock, in which case he will just hold his stake in the firm until the end of the period. And in this case, what is the distribution of firm value? The distribution of firm value is going to depend on the actual effort exerted by the insider. But now what if the insider is hit by a liquidity shock and cannot hold his stake until the end of the period? Then he's going to sell his shares at some price, and this is going to be some price P. But from the insider's ex-ante perspective, so at the time of choosing his level of effort, is going to calculate, so what is going to be the expected price at which I will be able to sell my shares. And so what's really crucial here is that the expected price at which he will be able to sell his shares is only going to depend on the manager's actual effort when the speculator is informed. When the speculator turns out to be uninformed, there will not be any informed trading, and so the actual effort of the manager is not going to matter for stock price determination. So the probability with which the stock price is informative is actually very important to determine the manager's effort incentives. And this probability is equal to this. And as you can see, of course, it is decreasing in the cost K of getting information. And it is also increasing in the profits pi from informed trading. And as we've seen before, the profits pi from informed trading are increasing in D. So this is increasing in the quantity sold by liquidity traders. So it is increasing in the amount of liquidity trading on the stock market. So having liquid stock markets is actually very important. It improves the informativeness of stock prices, which in turn is going to matter to determine what are the effort incentives of firm insiders. So it's going to matter for corporate governance. Okay, so to understand better how this works, let's consider two special cases. First of all, let's suppose that K is infinite. So there's an infinite cost to getting some information, in which case this probability will always be equal to 0. So the stock price is never informative. There's not any informed trading. And so the stock price P is independent of the insider's effort E. And the market maker does not observe the insider's effort, and it does not observe the realization of firm value either. So he cannot make any inferences about the manager's effort or about firm value. No. So in this case, P is independent of the actual effort by the insider. So what are the effort incentives? Well, again, there's two cases. It depends on the probability of the liquidity shock. If there's a probability shock with probability 1, in this case, the manager knows that it will always have to sell his shares at a stock price which is uninformative about firm value and therefore about the actual effort put in by the insider. In this case, the manager has 0 effort incentives. Right? There's no benefits to exerting effort because the stock price is not going to reflect any of that. Now, on the contrary, if the manager will never need to sell his shares at whatever stock price this is, and so in this case, the manager will have very strong effort incentives. Effort incentives would be decreasing in lambda, and they will be highest for lambda equal to 0. And so again, an infinite cost of information, meaning that there's no informed trading. So we have an uninformative stock price. This is the case when there's no interim validation of the insider's value improvements. Whichever actions the insider took when he had control of the firm are not going to matter for the stock price. And therefore, the manager will have very low effort incentives to the extent that he is facing a liquidity shock, to the extent that he might have to sell his shares before firm value improvements are revealed. Now suppose that K is equal to 0. So in this case, there's no cost to becoming informed, meaning that the stock price is always informative. So in other words, we are always in this case. And so the expected stock price is simply equal to this because this probability is equal to 1. Okay, so in this case, the stock price is actually highly sensitive to the actual effort E exerted by the insider. Okay, so this is great. Now, the stock price reflects value improvements, and so the insider has very strong incentives to make value improvements. Okay, so how can we interpret this model and what are the key messages? So the insider can be interpreted as a venture capitalist that engages in monitoring and advising of the firm. But of course, he can engage in monitoring and advising to a greater or lesser extent. So that depends on his effort incentives. What is the liquidity shock to which this insider, so potentially venture capitalist, is exposed? It can be simply that maybe he's going to retire, they want to transfer control, they have other investment opportunities for which they need to free some capital. So they might want to sell their shares for reasons that have nothing to do with firm value. So in this context, trading by speculators, by these informed speculators that do not do anything directly to improve firm value, can still be useful because it will indirectly improve firm value. So it requires some free float, which is inconsistent with having full ownership by the insider. If the insider owns the whole firm, then there won't be any trading that is going to be informative about actual firm value. So that suggests a reverse pecking order. In this case, the firm is going to need to issue some information-sensitive securities like equity, so that informed trading is going to reveal firm value improvements made by the insider. And then there's some complementarity between market monitoring. So market monitoring refers to informed trading by the informed investor. There's complementarity between market monitoring and active monitoring by the insider and the venture capitalist who exert some effort to make some value improvements. And in particular, the incentives to make such value improvements will be larger if the firm's stock is publicly traded, so that the firm's stock is informative and it reflects value improvements by the insider. And that suggests that the American model, in which you have both a vibrant venture capital industry, in which this venture capitalists exert effort to make actual value improvement in the firms, but also you also have very active public markets and firms that are taken public through IPOs. This can be complementary, right? Because the incentives for venture capital to make value improvements will be stronger when there is some market validation of these value improvements, for example, through an IPO, which will be the case when the stock price is informative. And in turn, the stock price will be more informative when there is some liquidity trading that increases the informed speculators' profits, and that increases their willingness to invest in information about firm value. Okay, so these two models of funding, venture capitalism and publicly traded firms, are not necessarily contradictory, and they can actually be complementary. There can be complementarity between these two types of ownership and governance.